Ben Bernanke's worst nightmare is coming true. So during the 2008 financial crisis, at the height of the crisis, he said his goals with this Keynesian experiment, this extraordinary monetary policy with liquidity and QE programs and TARP and bailouts and all these other gobbledygook stuff that has been carried on after Ben Bernanke, was to avoid Japan, was to avoid the US becoming what Japan has become. And yet, recently now, 2 Federal Reserve Board of Governor members are now saying that, get this is the irony of it all, and Ben Bernanke deserves almost all the blame for all this because he was the one who put the Fed trapped into a corner. Now 2 Federal Reserve Board of Governors are saying that the U.S. with the QE program going forward needs to have uncapped QE and to copy what the Bank of Japan, Japan's central bank, is doing. So the irony of it all is Ben Bernanke tried doing all this crazy stuff with QE, drastically expanding the Federal Reserve balance sheet to avoid becoming Japan. And now here we are, more than 10 years later, we have 2 Federal Reserve Board of Governor members talking about copying exactly what Japan is doing with their bond market and targeting yields. So let me read quickly this article. This was released on May 8th, so a couple days ago. This is a late night show, so if you want to have a drink, I have a beer right now. So our listeners are all over the world. I am on the East Coast, so it's a little after midnight here, and I have a beer and I'm just relaxing. So we're not doing the QTR 2-drink minimum rules, but we're just going to hang out after hours. I'll get this stuff in. It's important. So here's this article by Greg Robb, R-O-B-B, from Market Watch a couple days ago on May 8th. It says the Fed is dusting off a QE replacement last used during World War II. And then the subheading is targeting yields on longer-term rates used to keep down the cost of funding the war gets renewed attention from top U.S. central bankers. Okay, let me read the article now. Federal Reserve Governor Lael Brainerd, who I've talked about many times in the past, she's kind of a key policy person. She probably would have been U.S. Treasury Secretary had Hillary Clinton won. She actually got caught publicly donating, which is a big no-no at the Fed. You're supposed to be a secret Democrat at the Fed, a secret globalist at the Fed. You're not supposed to be publicly outed politically. But anyways, Lael Brainerd, and remember, Lael Brainerd had talked about an inverted yield curve before it happened. So she does open up her mouth and tip things off because she wants a higher political position or a higher job. She may end up being Fed chairman or Treasury Secretary in the not too distant future after Trump either wins re-election, whoever's after Trump, or if Trump doesn't win the 2020 election. So she said on Wednesday she became the second U.S. central banker to talk about the possibility of targeting long-term interest rates as a, quote, new tool to combat the next recession. It's actually not so new. The last time the Fed conducted such a policy was during World War II to keep down the costs of funding the war. The concept is relatively simple. If the Fed's benchmark interest rate fell to 0 and the 2-year Treasury yield was at 2%, the Fed could announce it intends to use its balance sheet to peg the 2-year Treasury rate at 1%. The general idea is that lower long-term rates spur activity. So this Keynesian that savers get punished, consumer spending is all that matters, government spending is all that matters, savers get punished. Fed Vice Chairman Richard Clarida floated the idea in a speech earlier this year. The link to that article is attached, and has done research on its use in Japan. Well, there we go. But I thought Ben Bernanke said the whole goal was to not end up like Japan. But I thought Ben Bernanke saved us. Okay, well, anyway, continuing with the article, in past downturns, the Fed was often able to slash short-term interest rates by an average 5 percentage points to combat recessions, but the Fed's benchmark federal funds rate now sits in a range of 2.25% to 2.5%, limiting the firepower of its main policy rate. As a result, Fed officials are casting about for new strategies that could pull the economy out of a ditch if necessary. Is Japan out of a ditch? Wait, I thought Japan has been filling those ditches with concrete. Wait a second, something's not right. Anyways, during the last recession, the Fed turned to the so-called quantitative easing, the buying of trillions of treasuries and mortgage-backed securities to lower long-term rates. QE was never popular and exposed the central bank to fierce criticism from congressional Republicans. Well, I guess we can tell which political party this article writer is writing about. And now Ken wrote which political party this article writer is from. And now Ken wrote back to the article. And now Ken Rogoff, a leading monetary policy expert, who's all for a cashless society and hates Bitcoin and hates gold. Ken Rogoff, a leading monetary policy expert at Harvard University, said academics have largely concluded that QE was not even a very effective tool to spur growth. You think? I mean, it increased the wealth disparity. It made asset prices higher. It kept U.S. capital gains taxes and property taxes higher. Brainerd said Wednesday she, quote, would like to hear more, quote, about targeting long-term rates. So not just the 2% as this guy is talking about in the article. Quote, once the short-term interest rates we traditionally target have hit zero, we might turn to targeting slightly longer-term interest rates. Initially one-year interest rates, for example, and if more stimulus is needed, perhaps moving out the curve to 2-year rates, end quote, Brainerd said. Yeah, well, in Japan, it's all their Japanese government bonds are manipulated. Some of them hardly trade at all. There is no liquidity there. And in a lot of American bonds, there is no liquidity. Some of those things trade, some of the corporate bonds, some of them trade by appointment only. Quote, under this policy, the Fed would stand ready to use its balance sheet to hit the targeted interest rate, but unlike the asset purchases that were undertaken in the recent recession, there would be no specific commitments with regard to purchases of treasury securities, end quote, she added. So I don't think the reporter understands this, but basically she said that if they can get away with it, they would like unlimited, uncapped QE each month to protect interest rates. And this goes back to the short video I made that the Treasury, the Federal Reserve are really, really worried about interest payments on the national debt. How much of the federal budget each year is being taken up by interest payments on the national debt? They are also worried about capital gains taxes on asset prices. And the state and local governments are worried about their property taxes if real estate falls. So under the program to target, back to the article again, I think I'm almost done. Under the program to target longer term rates, the Fed might be able to achieve its objective without acquiring many securities at all if its program is credible, said former Fed Chairman Bernanke in a blog post. That's interesting. There's a link to it. I didn't read it. I don't think it's worth reading it because you know what? Ben Bernanke was wrong. He said we wouldn't be like Japan, and now he's acting like he's an expert on this shit. Academics see some momentum building behind the idea. Oh God, here we go. So basically, Fed official, there's a tweet there saying, I get why the Fed sees yield curve control greater than negative interest rates. They effectively do the same thing via expectation theory of interest rates, but negative rates more politically toxic. My question, any evidence yield curve control is working in Japan or elsewhere? So this is from an academic. That is an interesting question. If yield curve control is working in Japan or elsewhere, I would say it's not working in Japan. So Fed officials are set to meet with experts and academics to discuss new ways to fight recessions and also a possible change to the central bank's 2% inflation target framework at a conference in Chicago in early June. So this is the end of the article, thank God. And Ben Bernanke, who's supposedly, he's pretending to be an expert. I mean, he was wrong in the first place, right? So no one should listen to him, and yet here he is being quoted in the article. Acting like, Larry Summers, who's been wrong for 20 or 30 years in a row. Just ridiculous, more bullshit from these guys. These Keynesians, this Keynesian experiment we're all in is a disastrous, and then of course they blame capitalism, or they blame, like in that article writer who's clearly biased, he blames Republicans for lack of support of QE. Pretty ridiculous, right? So if you want to learn more about this, besides the article, which I'll attach in the information section after this show is over, there is a good interview about an hour long from Danielle DiMartino Booth a couple days ago from Hedgeye. And she talks about the yield targeting, Lael Brainerd, how the U.S. intended to not end up like Japan, and yet here things are. Now they're interested in copying Japan. She also talks about MMT, and unfortunately, it looks like by the stupid things these Keynesian central bankers are doing, this bad Keynesian experiment, that they're setting things up for MMT, which will be very similar to what is happening now, only a lot worse. and will accelerate probably a collapse of the currency, especially in purchasing power. And then if there's inflation, God forbid, in any of the phony government economic data or any of the phony inflation data, then the MMTers will just tax it away. Because that'll solve all our problems, because inflation's not a stealth tax, right? Okay. Moving on. There is another really good interview that was released for free by Real Vision Television a couple of days ago. It is called Unfunded Pensions and Potential Disaster with Brian Reynolds from Skin in the Game. It's about 30-something minutes long. He is a former pension fund manager, and he talks about how crazy it is to manage pension funds and how these pension funds throughout the United States and probably in other countries too have just ridiculous expectations. So basically, they don't care what type of risk they take as long as they think that they can get like 7% per year. And the stories in there are just really, really good. He talks about how basically Wall Street just totally lies, cheats, and steals from the people running a lot of these pension funds in the United States. And unfortunately, a lot of the people running these pension funds, they're not very financially savvy. They're just like they're full-time teachers or full-time policemen or full-time firemen, and they don't understand all the risks that Wall Street is selling them. So the Wall Street salesman, for example, will say, well, we can sell you things that can make your 6% or 7% or 8% per year targets, but they won't outline all the risks. And the pension fund, the people on the pension fund board will just approve it. Hello, Pebble Man. I'm just picking up my beer and putting it down, so there's no farting. I'm drinking a beer, so I'm relaxing. It's after midnight here, doing a late night thing because I wanted to get this content out there. It's important, unfortunately. So here we are. We're heading to zero interest rate policy. We are heading to QE infinity or QE4. It is uncapped. So it is not officially announced yet, but that is where at least these two Federal Reserve Board of Governor members want to push things. So it might not be $30 billion a month. It might be $50 billion, 60, 80. We don't know. They might not even announce it. Hopefully some source will come forward then with what I got about the central bank to central bank currency swaps. Hopefully a brave whistleblower will come forward then if they're not going to announce what the uncapped QE is then for yield targeting. Hopefully someone will say, it's like, it's $100 billion a month, $200 billion. Okay, so continuing on the pension fund crisis, I talked about it in my short video about how quickly the U.S. national debt is growing. There is a $400 trillion pension fund crisis by 2050. It's globally, but a lot of it's also in the U.S. And not only is it that it's a combination of factors. There's actually a really good interview on Chris Martinson's YouTube channel. It was on his paid podcast, but he released it for free a month later. It was a few months ago. It was from a pension fund lawyer. So this guy sues pension funds because they don't have to release a lot of data publicly. So there's almost no transparency with a lot of these pension funds, so they don't have to release how badly they're getting ripped off by Wall Street. And so in some of the documents on their websites for some of these pension funds, they say that they're only paying, for example, $10 million per year in fees to Wall Street if they're managing billions of dollars. Well, he sued one of these pension funds, I think, for the state of Rhode Island, and he found out that they were getting ripped off more than 10 times what they were claiming. So they were managing many billions of dollars, but they were so inept and were getting ripped off by people on Wall Street so much, and hedge funds so much, and private equity so much, that they were paying almost $100 million a year in fees that was not being reinvested and was being wasted. And they were only claiming in public on their public documents that their fees were only around $9 or $10 million per year. So I will try to get that link for you guys, and I will put it at the end of this live stream show. It'll be attached there at the end with links to like my Patreon and things like that. So you can take a look at that interview. So along with like the Danielle DiMartino booth and the other free Real Vision television interview, I highly recommend looking at that if you want more of a grasp on how bad the pension fund crisis is. And I actually have another story about how bad the pension fund problem is. There are some pension funds that are run by competent people, but a lot of them are not. And a lot of them cut corners in places that they shouldn't. There was a local pension fund a few years ago here in the Washington, D.C. metro area, about 25-30 minutes away from where I am. And they actually contacted me about going in there for a job interview. And they saw my resume and said it was very impressive. And they asked me how much money I wanted. And I said, like, $65,000 to manage your money. And they flat out told me, even though they had tens of millions of dollars, I think it was maybe around 100 million or a little under 100 million to manage. And they straight up told me that I was asking for too much money. They said straight up that it was a quote unquote part-time job. They couldn't pay that salary, and that all that person who had that job had to do was just pick out which funds the Wall Street people were selling them. So, and I was like, oh my God, I can't believe you told me that. And I was like, because I was telling them, like, look, I'll do the research and I'll pick out some diversification and either individual companies or sectors and things like that. And they're like, no, it doesn't matter. It sounds like you could do a good job. They're like, we just straight up can't pay you. We don't want to pay those fees. And I was thinking to myself, you are straight up going to be ripped off for millions of dollars per year, if not more, in fees by the Wall Street people selling you the garbage, or the private equity people or hedge fund people who are charging you 2% per year management fee plus 20% of the profits. And you don't want to pay me $65,000 a year to oversee these things? It was just ridiculous. So they only wanted to pay someone like on a part-time basis just to pick out like a list of things that the Wall Street guy, whichever one came in, whichever guy in the fancy suit, or maybe didn't even fly in. He was just going to do it over the phone because, this was too small of an account for someone at one of these large Wall Street firms. There wasn't enough sweet bonuses there. They were saying just wasn't worth it. They didn't want to pay me $65,000 per year. Meanwhile, to do any research or anything like that, and at least ask good questions to the person handing the list over. And meanwhile, they were going to get ripped off for many millions of dollars per year in fees. And I can tell you that, and not only the fees, right? Not only is Wall Street siphoning like a parasite off more and more fees per year from almost all of these pension funds, but they're not making good investments either. So not only are they getting killed in fees from Wall Street salesmen and private equity people and hedge funds to a large extent, but they're also investing very poorly. So it's a double or triple whammy. So they're not going to make anywhere near their 8% target, but there's just some really good stories in the Real Vision television interview with the guy about like how these pension fund managers will buy almost as long as the Wall Street salesperson is promising them that they can meet their yield target. And apparently these pension funds now prefer very, very risky high yield debt. So if they can make their 7% in junk bonds buying shale garbage, that Wall Street is, or private equity is promising them like 7 to 10% returns, even though it's high yield, because it's really junk, because it could go to zero. And Wall Street salesmen are calling it high yield, even though it's junk and very risky. But these people are not who are in charge of the pension fund boards, because they won't pay the money to hire. Now, some of them do, but most of them don't. They won't pay the money to hire a full-time money manager. They're going to lose tons of money. Yeah, Billy, this is a good point. Unfortunately, it sounds like the guy who did the interview from Real Vision, Brian Reynolds, he said that this problem has been going on for 40 years. And he says it just gets worse every few years. And that the pension fund boards, so these teachers, these firemen, these policemen, these government employees who will not pay the money to hire a full-time financial professional to help them, and at least ask the Wall Street salespeople and private equity people and hedge fund people better questions, that they just keep chasing whatever credit bubble is going up. So if it's like shale oil debt, if it's high yield junk bond debt or corporate debt, very risky stuff. And those pension fund boards aren't going to ask questions like, well, why are we why are we buying these corporate bonds when this corporation, their credit rating is way too high, that they should have gotten their credit downgraded. And a good analyst like myself could figure that out in a couple hours worth of research work, just looking at the company, reading the annual reports, reading the financial statements, looking through the disclosures, those types of things. And they're not even doing that. So they're cutting corners in places they shouldn't, and it is going to, in the long run, it is going to hurt the members, like either the government employees, the teachers, the firemen, or the policemen. That's one of the major reasons of the pension fund shortfall. There's about 3 or 4 main reasons why, and it's all really sad. But the Brian Reynolds, he brought up in the interview, I found this interesting. He thinks for sure there will be bailouts for pension funds at the state and local levels. I'm not sure if that'll happen. He thinks the federal government will do it. Just something else to think about, right? Another economic landmine, another problem, more bailouts. So I forgot to bring this up about the treasury yield. So on the 10-year interest rate, on the 10-year US Treasury, it got as high as, let's see here, 3.21. Nope, 3.22. So on October 1st of 2018, it got to 3.22. And since then, there was a couple attempts at going higher, but it's just gotten knocked down. And here we are at 2.455. So basically, the Fed has already been implementing to a lesser extent what it's planning on doing with knocking yields down. Well, I think one of the reasons that John Bolton is so adamant, and he admitted this publicly, about the U.S., the foreign policy, the neocons wanting to go into Venezuela and regime change is because they're worried about shale, the economics of shale. And they want to get that oil production in Venezuela back up from lower than 500,000 barrels per day back up to 4 million. John Bolton, who's a total scumbag, big neocon, he's really devious. He's clever and charming, but a devious liar and a bad person. He admitted that it's all about oil in Venezuela. So the regime change and all that other stuff. Okay, so also China walked away from a trade deal and they vowed retaliation. I mean, this was predictable, guys, right? President Trump, I put out a tweet. I quoted Trump in the tweet. Let me see if I can get this up here real quick. Hopefully my phone won't make sounds. Let me read the quote that I quoted on Trump. Yeah, sorry for the sound. Let me just pull it up. I think this tweet's funny. Okay, here we go. So China walked away. They will retaliate now. And you, Larry Kudlow, and other Trump administration members were lying about trade deal progress every day, Monday through Friday, during market open, to manipulate the stock market in parenthesis. For what, over 8 months now? And so Trump is like, oh, no big deal. No big deal. We're going to be fine. China's going to retaliate. And I've been thinking about this a little bit more about how China can retaliate. The biggest pain point China can do, and China's already sold some U.S. treasuries, but the real big pain point that China can do, and this would cause Donald Trump's phone to increase ringing off the hook by U.S. corporations and lobbyists for U.S. corporations even more than it is now, is if China just said straight up that we're not allowing any American corporations to have access to our rare earths. That would hurt technology and electronics companies. It would hurt defense companies. So if China really wanted to go for the jugular or the low blow, kick the U.S. in the balls, China would not dump all the treasuries. They would go after the rare earths because that would stop a lot of the U.S.'s products. I don't know if China will do it, though, because there's so many people in China that like Apple products and other products. Those products, electronics and things like that are very, very popular. But I mentioned earlier this week when I was discussing how the U.S. versus China trade deal will escalate, and it looks like it is going to escalate like I predicted. But I think that some of these Chinese oil companies will also start to cancel oil service contracts. So you have like 3 really big state-run Chinese oil companies, and they've used a lot of the U.S. oil service companies to help them drill and do other things in the past. And it's pretty much common knowledge that the U.S. oil service companies are very efficient and very good at what they do. They offer like a very wide range of products and services to help. But I could see China potentially canceling many billions of dollars in contracts from like Schlumberger and some of these other corporations, oil service, and then straight up saying like, we're taking all of our oil service contracts to Russian companies. Oh, there's my highlighter. I was looking for it. I'm not drunk. I just forgot where my highlighter was. This is my first beer. I'm still sipping on it. So, why is the U.S. intervening in asset prices and stock markets? I think a lot of it, besides the capital gains tax revenues, a lot of it has to do with property taxes. Now, I don't own my own home. I rent, but most of my listeners have their own place. You can tell me, are your property taxes going up? Because whether it's inflation, deflation, stagflation, noflation, shrinkflation, sideways, asset prices falling, guess what? The politicians at the state and local level, they want to raise your property taxes. And from what I've heard from my friends in Vancouver, that was a big reason that the politicians in Vancouver allowed knowingly, because they were told this many years ago, and now there's stories coming out. There was a Reuters story in the last couple days, so all this is finally coming out now, but it's been known for over 10 years by Vancouver politicians. They just let it happen. They let all this drug cartel money, all this Chinese, laundered Chinese money just go into Vancouver and buy houses. As long as the property values would go up, that meant higher property taxes and more revenues for the state government. And this is a global problem, because when the state of Illinois has huge problems, they can't pay their lottery owners. There's delayed there. If you win the lottery in Illinois, I don't think you get paid on time like you should. They give you like some type of weird IOU. And the state of Illinois, their solution to all their problems is, oh, we'll just raise property taxes another $5,000, $8,000, $10,000 per year, depending upon what your home is worth. And the politicians, Republican or Democrat, mostly Democrat, because Illinois, a lot of it, especially around Chicago, in and around Chicago, is almost entirely Democrat controlled. And they just see it as, oh, no problem, we'll just raise taxes, property taxes. Stunner says, come to New York and you'll learn about escalating property taxes. I was born in New York and my family moved to Southern California, and that's where I grew up. But I have family members from New York, and you know what? Almost all of them have left. And a lot of them talk about how expensive it is and the taxes, the property taxes. So yes, I am well aware of how crazy things are in New York. And you know what? Do you really have private property if the government at the federal, state, and local level is going to keep jacking up the taxes? I would say that's not real private property rights then, if they're going to keep jacking up the taxes like an insane amount every year, every couple of years. That is crazy, man. For a single bedroom condo in property tax, $9,000 in property taxes and $300 in HOA fees. Are you in New York City or are you in a suburb? Are you in one of the main boroughs? Well, I've been saying this for years now, guys. There is a global bull market in corruption. There was actually either an IMF or a World Bank report out, and it said that world governments could raise another $1 trillion in tax revenues per year, at least, just if they came up with plans, like a bunch of different plans, to figure out ways to reduce corruption. That is how bad corruption is. It's not just the US, it's not just China, it is pretty much everywhere. I've heard crazy corruption stories from people I met in Brazil. I've heard crazy corruption stories from people all over the globe. Well, I think the U.S. and China, it's basically like the Titanic versus the Lusitania at this point, right? Who's going to collapse first? Which is not good for the world, by the way, because normally, as the economy gets worse and worse, potentially, normally, historically, now we have nuclear weapons. Normally, though, in the past, when the economy got this bad before nuclear weapons, there was always a world war. Or some type of massive war. Not necessarily a world war prior to World War I, but there was a massive war when the economies of multiple countries with big economies got that bad. So, more about China. We talked about Chinese money laundering in Vancouver. Well, that's a global thing. So, I think, and I've heard tons of evidence of this. One of my friends who's a hedge fund manager just started talking about today. He was telling me that more of his contacts are getting money out of China and using it like certain types of funds to buy real estate all over the globe. So, in my opinion, over the last 10 years, China has caused an enormous amount of real estate bubbles all over the globe, either caused new real estate bubbles or reflated old ones. Bitcoin is over $6,000 again at 65.78 on CoinMarketCap right now. And there was a story last month about how Chinese margin debt for stocks has increased a lot, and probably a good amount of that margin debt's also going into Bitcoin. So there's a lot of speculative gambling. Now, Chinese citizens are not allowed to own Bitcoin, but a lot of them are tech savvy and can figure out ways around that. They can use a VPN and probably trade crypto on a Japanese exchange or South Korean. Greg says, hey, Jason, do you remember the Mogambo guru? You remind me of him. I've interviewed Richard a few times. He's retired now. I interviewed him for one of the first few episodes of Welcome to Dystopia years ago. I used to read his articles. Yeah, he was funny. I don't write entire, like, satire stories, though. But, yeah, I pick and choose my spots. Are you in Australia? Oppose deception, oppose deception. Okay, you are in Australia. Just read your next comment. Our central bank in Australia has indicated they are prepared to take rates to zero in QE if necessary. Well, that's Japan. This is the end game for this stupid Keynesian experiment that all these Keynesians all over the globe have put us in. And it's going to end, the best case scenario is going to be stagflation and taxes. Stagflate and lie. Or worse. The best case scenario, like I said, stagflation and taxes. Worsening stagflation and taxes. Australia has some gold mines. You got Kirkland Lake. Well, you have Fosterville there. You have some gold mining. You don't have enough of it. You have individual gold miners, but yes, the Central Bank of Australia, I don't think has any gold. Not that the Canadian bank does either. Canadian Central Bank. Exactly, T. Waters. When all you have is a hammer, everything is a nail. This is the problem with the neo-Keynesian view and Keynesian economics in general. I'm reading Bitcoin Standard now by Safadine Amous, and he talks about how Keynes actually never studied economics. So this guy was a fraud in college. He was just because he was from the right bureaucratic academic family that was pretty high up there and well respected. He could get away with drinking and doing drugs and orgies and being a pedophile and all this other crazy stuff. And because of his family background, he could pretend to be an economist, and people respected him. ARGTV 100 bet you $1,000 person who told you that 65K too much was a female. It was years ago. I can't remember. It might have been. It doesn't matter because it's just very frustrating, man. Because I was trying to explain to them, like, you're going to get killed. Wall Street's going to take you to the cleaners and fees. Didn't care. Didn't care. Hey, Taylor, good to hear from you. Yeah, there's a empty house tax now in Vancouver. There was a documentary that came out about 2 or 3 years ago. And the politicians, there's so much outrage because a lot of people in Vancouver who make like $50,000 a year, they have to commute 45 minutes, an hour or more to work. And some of them can only afford to like rent a basement in someone's house that far away. And that's all they can afford. So the native Vancouver people are being forced to commute further and further away because they can't afford to live downtown. And that's because the Vancouver politicians allowed all of this drug cartel and dirty Chinese money laundering money to come in. Yeah, Taylor, it's good to hear from you. Unfortunately, I've had like 30 people cancel their Patreon, so I've done all this work. I spent 6 hours on the how quickly is the U.S. national debt growing. I had to use... There's only a couple thousand people that know how to do that work on YouTube. You don't see that many people do that stuff. Especially in our community here, in the alternative media and gold and silver community, financial community, not a lot of people can do that. That took 4 software programs and 6 hours of work to do all that, to make the video like that. There's just very few people that can do that. And yet, I got almost 600 likes on the video, and only about under 7,000 views so far, which is weird, because on other people's channels, if I saw another video on another channel that had 800 likes and 30,000 views. So my like to view ratio is bad. It's the YouTube censorship net that my channel is caught in. They really don't want me here anymore. And you know what? I probably shouldn't be here anymore making free content, because I'm spending a lot of my time doing this, and it's really not worth my time anymore. But I do enjoy actually making the content. It just takes up so much time, and then I get nasty emails sometimes from really rich people telling me, fuck you for asking for any money. If I would have gotten a business partner already who was competent and actually had money and business contacts, then I wouldn't have a problem with all this stuff. It's just been very frustrating all around. The whole plan years ago was to have a good day job and then not worry about too much money coming in, that this was going to be a side hustle and any extra money that came in was going to be fine, and nothing has really worked out according to plan. I hustled a lot last year and made a living off that, but it's not a good life, what I have right now. It's just too much stress and it's too much up and down. My life is incredibly stressful right now. There's so many things that are very frustrating in my life right now. Okay, well, I think that's pretty much it. I think I covered everything I wanted to cover, and I will attach links to all the videos that I suggested that you guys watch. There's tons of questions coming in. I could take a couple more. ARGTV 100. Intellect is punished. Well, I would say that in our society now, very, very smart people, if they don't have the certain resume, if they have too much experience, if they have too many credentials now, and I've heard this a lot. I've heard from people in the financial industry in the past that my resume and my credentials and experience are too good to get a job. I've actually heard that. And 6 or 7 years ago, I was interviewing for $100,000 a year financial historian, private equity, and hedge fund jobs. Interesting. Okay, well, that's it for right now. It's getting late here. not too many minutes away from 1 a.m. I want to finish this beer off. It's getting warm. Chris Irons of QTR would be upset at me for letting this thing get warm. Okay, well, that's it for right now. Everyone have a great rest of your weekend. Okay, bye.